Okay, now let's see. This is the test. How about that? Go back one. Okay. I think this is roughly where we left off. And this is discounting again. This is so one of the things you can do in finance is you can do what if? What if the interest rate discount isn't 5% per year? What if it's 6% per year? How does that change value? And this gives you a relationship between the interest rate and the value of the cash flows that in the case of treasuries, known cash flows that you're going to receive. Uh, uh, Now, one housekeeping note, I was just informed by the parking lot patron that I have to be there at 3 o'clock or they're taking my car and driving it off a cliff. In which case, so I have to leave. I don't have to leave early, just not as late as I thought I would stay, and we'll make it up next week, no problem. Okay, so yes.
If you get a bond, let's say
Okay.
and it was 10-year bond,
Yeah.
and you're on year 6,
Yeah.
year 8. Bond value, of course, has gone down yearly, not what it does. But if your bond is at an interest rate that is higher than going rate,
Yes.
that bond could
Absolutely. As an example, the issue of the confusion was on the English as to did you mean over time in terms of the discounting rate or as the bond amortizes in time, you get closer to maturity, and obviously you have fewer cash flows to be discounting, and so yes, and believe it or not, this is what spreadsheets are for. This is why spreadsheets are used throughout the finance industry and banking industry, because these kinds of calculations are relatively easy to do. All of these were done in a spreadsheet. And what it shows is, well, what do you know? You have value sensitivity associated with known cash flows. And this sets up one of the things that a lot of people do not realize in finance. You cannot get rid of both simultaneously unless you're just talking about something you're going to get back tomorrow in terms of a day. It's called overnight funding or something like that. But other than that, every financial instrument has sensitivity to what's the underlying interest rate, and so do stocks. Why do you think the stock market is rallying as we speak? It is rallying as we speak because investors, defined by whomever's out there buying and stocks, have started to get the idea that, maybe the Fed has stopped raising interest rates. They haven't said they're stopped raising interest rates. They just said they kind of expect to stop raising them next year. And because that means the interest rate or the discount rate at which you discount the expected future earnings of those stocks goes down, the value of the stocks goes up. And that's what's being reflected in the stock market. Of course, there's great volatility that's changing. As I've said, it changes its mind every day, every minute of every day. Okay, so let's talk about actual name about bond duration. This is another term I can tell you. In a bank, I worked with the CFO, and he thought duration meant maturity. And I said, no, it means price sensitivity. It's a financial definition using an English word that most people think means something, and it doesn't mean that. And you can open up any finance 101 textbook, you go to the index, you look price duration. Oh, let me look it up, and they'll give you a formula for price duration. And what this says is that this price sensitivity of how much does a bond, how much does its value change, is sensitive to its maturity, which, notice the word maturity here in years. Okay, it's price sensitivity is sensitive to maturity. And that's why you might hear as a bond ages, it's become the price sensitivity starts getting less. Its duration is sensitive to how much maturity you have remaining on the bond. As the bond gets older and older, it's therefore less time to maturity. And so therefore, as you're essentially sliding down this mathematical relationship between price sensitivity and the maturity remaining. Okay, so one of the things that we can do is we can look at the price volatility of a 10-year bond over 1 month based on what's happening to interest rates. Why am I doing this? I am doing this to illustrate. Don't kid yourselves. If you get hooked into thinking about the value of fixed income instruments that have essentially no credit risk, like treasury bonds, you might see this kind of volatility in a statement from Schwab, Merrill Lynch, or any of the other brokers out there telling you what is the value of that investment. It is going to vary, and it's going to vary with this underlying very volatile thing that we call the yield curve, which I showed you in that movie, how it's flapping around. It's flapping around today too. And as a result, depending on exactly how you translate that information into the discount rates for discounting those cash flows, you generate value sensitivity. So the purpose here is to set up, it's not a paradox. It is the nature of finance to think in terms of the difference between values. What can I sell it for today? What can I buy it for today? What is its value versus receiving something over time, such as you take out a bond and you receive interest payments every 6 months over the life of a treasury bond, and then ultimately get your principal back. They're very different constructs, and they're married at the hip, and it affects everything, such as mortgages. How do they calculate the rate? How do they determine what the right rate is on a mortgage? Well, if it's a 30-year mortgage, it's based on the cash flows associated with the 30-year mortgage, which are typically monthly fixed interest rate. There's an actual mathematical formula that says, okay, based on current interest rates, i.e. the yield curve, you give me that information, I can tell you what's called a par mortgage. Yes. Glad you asked. That's why I like this is why I favor doing it in person, because people are more comfortable. I encourage anyone at home who's listening, if you have a question, be sure to raise your hand. Embedded in a yield curve is the market expectations of future interest rates. Okay, it's embedded in the curve. There are these very deep financial markets where that people are trading back and forth with different components of the yield curve. And all of that is based on, gee whiz, what path of interest rates gets me to that rate for over 10 years? What is the exact path that gets me there? So as you shift that curve, you're not just shifting the 10-year rate, you're shifting the string of short-term rates that get you to that. That's right. And the formulas for that have to do with forward rates, and it's more complicated math, and you don't need it. You need to know the concept. And the yield curve, this is why I just got to put in this political statement. Anybody who says the US can default on its debt, they're nuts. Okay, they're absolutely, the US should not default on its debt. The treasury curve This entire purple curve here represents what's called the benchmark credit-free interest rate at any point in time. Yes, it's changing every minute in terms of how the markets behave and all the rest of that stuff, but it is the benchmark. Everything, every financial instrument in the United States is in a sense priced off of that curve. Some of them are really complicated. When the Treasury curve moves, even value of stocks will change as the Treasury curve moves. So to give you an example, very short term, the prime rate is correlated with a very short-term end, as essentially it's the discount rate at the Federal Reserve. As they change the discount rate, the banks change the prime rate. Okay, you have 15-year mortgage rates. Its maturities of roughly weighted average maturity of about 7 years. You play around with that, but it's as this piece moves up and down, the fixed 15-year mortgage rate will move. Similarly with the 30-year mortgage rates, all of them, they're all correlated with the movements of this underlying curve. If they break the rule that says we never defaulted on our national debt, it's opening Pandora's box. And the attitude of economists really is, we really don't want to know what will happen. It's not worth finding out. It's just easier to pay interest on the national debt, which is part of our, just so you know, it's part of the next lecture. Okay. So yield curves are important. They're a fundamental construct underlying financial markets, corporate bond rates. Federal Reserve is looking at how the market is responding to economic conditions in terms of setting its own policies. And it's all manifested in this one relationship. And that's why people use it, because once you get it, it's not that hard to at least think about, oh, what is the relationship between short-term and long-term rates, and how does that affect it? But just consider the characteristics associated with an interest rate investment. Equity investments, you think in terms of stock, the stock, the earnings, Apple, Google, or the junk that I buy, which is the best thing to do. If you hear me recommending an individual stock, that's the time to sell it. That's the history. Age of 70, that's my history with buying and selling individual stocks. So maturity, is it long or short? Deposit insurance. People care about deposit insurance. It's one of the reasons they put money into banks, because it's insured. How does deposit insurance, how does it really work? How did that influence SVB? Why is it the First Republic Bank went down? All related to the structure of deposit insurance and how people think about it. Tax treatment. There's there's muni bonds, which in California are triple tax-free. There's treasuries, which are state income tax-free. All these things matter. There's credit, lots of credit risk. The words credit risk, very easy to say. Credit risk, very, very difficult to evaluate credit risk. There's nothing trivial about evaluating it. And that's why there are specialist traders out there who they trade in specific instruments based on differential credit moves. They're called credit spread traders. Yes. Oh, I have no opinion on that matter, but I do have an opinion on how well or poorly S&P and Moody's did their jobs with mortgage instruments in 2007 and 2008. It's a known story. It's in the movie The Big Short, in terms of how they were gamed. The investment bankers learned how they rated, and they manipulated data in such a way to make them think that these were very low risk, when in fact most of their ratings didn't hold up, not even a little. It was one of the contributors to the crisis. Inflation. I'm going to talk a little bit about tips, Treasury inflation protection securities, which have been issued for years by the Federal Reserve. Whether you're buying discount premium, including zeros, a zero structure is one cash flow at maturity, no intervening cash flows, how are they priced, et cetera, et cetera. Whether or not you have embedded calls are they're in muni bonds and corporate bonds all over the place. Oh, there is nothing trivial about valuation of embedded calls. Yeah, they exist, and that's one of the reasons they exist. Yes. Yes, it gives it, they it's called an exercise option. They own it, and if it's in their interest, they will exercise that option. And if they exercise that option, it's not in your interest. I'll tell you one, I'll tell you a story about a little baseball entity called the San Francisco Giants. The story is that the Giants issued bonds to finance whatever the name of Pac Bell Park at the time. I can't remember what the original was. And one of their finance guys got involved with Chase Investment Bank, and they sold them a bunch of derivatives to change the maturity and swap out the maturity. We're not going to get into derivatives too much, but it changes the underlying structure by taking on another contract. Interest rates moved against them. The accounting was, you got a $4 million loss, you got to report. So a big meeting was called, and the CFO actually said to me, said, well, Chase would never exercise that option if it hurt us, would they? And I said, I don't think you understand the option that you agreed to. They would only extend it if it hurt you financially. Yes, these things get very highly paid people do not necessarily understand these structures. They're very complicated. They're very difficult to value. And if you have a home mortgage, you're living on top of one of the great options that you own. And that is the option of prepayment without penalty. That's right. And it's driven the entire housing market in the United States. Why? Because as interest rates came down, people kept refining their mortgages. And there's a whole bunch of homeowners out there that now have mortgages of 2.5%, 3%, and they're not about to move. And because there's a shortage of people moving, housing prices have stayed high. It's an incredible story. I'm telling you, you can't tell the future on this stuff. You got to be careful. There's complexity, and you just have to know how these. If you're buying from someone you trust, a broker, they're going to fully disclose how these things work. They may tell you not to work about it, but the basis for the putting in the call in there is the market's a little fudgy and exactly how it values that call. And it's part of the instrument. If you want the instrument, they're going to have the right to refi it at various times. Also, municipal bonds, the whole municipal bond market, of course, works like a totally different way. Okay. What about investing? As we get older, we may desire to reduce the proportion of our financial wealth from stocks. Most brokers will advise you to reduce the equity position because of the volatility of equities and getting older and what it means. And if you're risk averse, you put more of it into fixed income instruments. Okay. And you can do various kinds. The financial supermarket that's out there, and it's really, this is part of the capitalist system. I always use the cereal aisle Safeway analogy to talk about financial instruments, which is, how is it they keep coming up with new cereal? How is it possible? They come up with new shaving creams, they come up with new razors, they just constantly, they're doing little tweaks and putting them in there. it's the nature of the capitalist system to come up with changes. It's called product differentiation. There's books on this whole stuff in terms of how it works. It's also true with financial instruments. It's just that one of the ways that financial instruments evolve is they get more complicated. Ergo, the meltdown of 2008. Complexity was a big part of that. So we're going to focus on U.S. Treasury-backed interest rates, carefully avoiding the issues associated with credit risk. So let's first talk about these guys. Anybody in here invested in TIPS? Have you heard of TIPS, Treasury Investment Protection Securities? Well, and the last time I did this course, I had someone who bought Treasury Investment Protection Securities, and he is a very, given what happened with inflation over the last year and a half, he's a very happy boy. Okay, how do they work? First, you look at the market. They publish this information? You can look at a coupon on a TIPS. You can look at a coupon on a Treasury at the same maturity, and you'll say, they're not the same. How come they're not the same if they have the same maturity? And the answer is because the TIPS has the following feature. It says the principal balance on your outstanding security is going to adjust every year associated with the inflation rate. So if you bought $1,000 TIPS bond and the inflation went up 10%, it's suddenly going to be worth $1,100. It is known as a hedge against inflation because the value of the security goes up. And the last principal payment is the adjusted amount. Future interest payments are based on the recalculated outstanding principal. And if the market thinks the inflation rate is going to be 2%, and then the inflation rate becomes 10%, you've got yourself a security at a price that has grown much more in value than you might have expected. And the way it works is you just write down the cash flows and do a simple calculation and say, what does it mean? Since it's treasuries, there's no credit risk, right? It's just protected against inflation. By the way, the reason the Federal Reserve likes TIPS is because it gives them a market read on expected inflation, with emphasis on the word expected and the word market expected inflation, as you'll see in a second. In any case, you just look at a 5-year. I did this example with a 5-year bond at 3%. So this was done a while ago, and 5-year TIPS at 1%. Okay, and it turns out that at any point in time, you discount the cash flows, okay, associated with these two streams. They have to be the same, at least approximately have to be the same, because they're operating the same financial instruments, and theoretically, if they're not the same, then the market's going to evolve to the opposite security. So TIPS are a hedge against inflation. Notice that in this example here, this is the CPI going at 2%. This is what your cash flows would be each and every time. And this is what the cash flows would be this time. And you add them up and you go, well, what do you know? Higher inflation gives me higher cash flows. That's a hedge that says inflation's going up, I want to be paid more. It's kind of like indexing retirement pay and adjusting retirement pay in retirement contracts adjusted associated with CPIs. Okay, so we can look at this information, and what I've graphed here is the data. This goes back to September 2003 when they were first issued. You do a graph and you say, what was the 5-year treasury rate? What was the 5-year TIPS rate? As expected, the TIPS coupon should be much lower. We're not expecting deflation. We're expecting some inflation. You do the subtraction, and it gives you just the subtraction. It gives you what that market expects inflation to be. And the Federal Reserve, if you go into their meeting notes, literally in the last year and a half in their meetings, they reference this graph, not mine, but theirs. They reference this graph is what is the market signaling us as to what it expects inflation to be over the next 5 years. And this uptick here, do you see that guy? That motivated them to increase interest rates. That was one of the factors that said, we better get this under control because these guys, look at this. They've suddenly, that market's responding. They think there's going to be higher inflation over the next 5 years. We don't want that embedded into the system. So we're going to try and reduce it with higher interest rates. Okay. So how to think about security maturity. First, are you investing? It's the classic. Are you better investing in the short term or the long term? How good is the market at forecasting interest rates? Remember, if the market was a perfect forecaster of interest rates, then it shouldn't matter what you do because you're going to get the same returns, and the market's a perfect forecaster. So it shouldn't matter whether or not you just buy a series of short-term interest rates or you buy long-term interest rates. Huh. Do I have news for you? And these are highly paid people. They're not terribly good at predicting what's going to happen to short-term interest rates. What does that tell us? If people who are paid lots of money to buying and selling these various kinds of treasury securities, that highly paid bonuses based on gains and losses, and they're regularly wrong, what does that tell you about whether you're able to know where future interest rates are going to go? I can tell you, you don't. You just think you do. And every once in a while, you're going to say, oh, I expect this, and it happens, and you're going to think you know something. But the reality is you don't, because the people who are setting interest rates don't know what's really going to happen. There's so many things that can intervene this year in terms of what happens to interest rates, including a presidential election. So it's understanding the basics of how these markets work that give you information about how you should think about it. Because if they don't know, you don't know. And that is one of the underlying principles. So we can do some tests. We have interest rates. We have interest rates time series. We have short-term interest rates, long-term interest rates. We can see we can calculate the implied rate in a 5-year maturity and a 1-year maturity and compare that to what happened with interest rates. So let's do this. Which would provide greater returns? Investment 1, 3-month treasuries. Investment 2, 1-year treasuries. I use January 1990 through July 23. And the idea would be, if the markets are perfect, this red line should be right here. The red line is not there. And that's because interest rates are very volatile. The markets don't really know what they're going to do at any particular minute. And so you can do this rolling 3-year returns against 1-year returns and saying for each period, which one was better? And the answer is, it varies. Sometimes 1 year is better. Sometimes rolling 3 months is better. If it looks like this, what does that tell you about what you're going to be able to do in terms of thinking about maturity investing and interest rates? What about providing returns? What you get is, instead of a very narrow distribution around the idea that it really didn't matter, what you're getting is, well, investing in 1-year treasuries versus the 3-month, sometimes it was a better deal, and sometimes it wasn't. It's the nature of financial markets. It's the nature of the real world, and virtually most of the stuff you're going to hear on the media, one way or the other, at parties, among friends, from your kids, from your grandchildren, is some statement that they know what's going to happen because they think they know what's going to happen, but they don't know what's going to happen. I've been in the business a long time. I finally gave it up. I really did. I should tell you, when I got out of graduate school and started working at Citibank, I said, I know, I get it. I've got all the information in the world. I know what's going on. No, I don't. So we can do the experiment with 3-month and 5-year treasuries. You can do it. You can do it with different lumps on the yield curve, and understand what traders are really doing. They're called govy traders. Okay, they're on a desk, and all they're doing all day long is trading and buying and selling various maturity treasury bonds that are on the market. All they care about. I learned this from a govy trader. All they care about. They don't care about macro policy. They don't care about Keynes or Krugman or Federal Reserve. All they care about is that they bought something and they're holding on to it. The price goes up while they're holding it. They can also short it, in which case they want the price to go down while they're while they've shorted it. They make money, and the calculations for them in terms of the institutions they're working for, very straightforward. All kinds of procedures for this, and if they make from doing that activity $5 million for the bank, the going rate is roughly about 10% of the gains. So they have an incentive. There's an incentive for their own incomes. They want to do well because they make more money if they do well. So they don't care about the reason. They just want to know, am I buying? Am I selling? And what am I buying? What am I selling? Yes. Okay. An inverted yield curve, which you'll see, they're slightly different measures of it, but it means something from typically about a 1-year point maturity on the yield curve to something like a 10-year point or 5-year point on the yield curve. The relationship is negative rather than positive. Namely, the 5-year rate is below that, and we have inverted yield curves. Yeah, yeah. And what is that usually? No, you said should. That's an East Coast verb. No, no, it's not a should. It is telling you what the market thinks in terms of how it's behaving and buying and selling these instruments, what it thinks is the future path of interest rates. And that's why there's this quick genuflection when you see inverted yield curves. The bond market is telling you they're expecting a recession, i.e., they're expecting the Federal Reserve, because of a recession, to suddenly cut interest rates. So the 5-year is above in that particular example you use, the 5-year is above the 10-year because they expect future short-term interest rates to be even lower. And you can do financial calculations to justify that, but that's why you get inverted yield curves. It's the market statement that rates are going to be lower in the future than they are now. Yeah. I believe we do. I haven't looked the last couple of weeks. We certainly did a few weeks ago. By a little. Yeah. Yeah, it's one of the common statements. I think I included that graph here. You'll see in a minute. But this word inversion, it's a beautiful example. Why? Well, it's English. And it's bandied about. People say it all the time. Oh, we got an inverted yield curve. And 99% of the audience go, what does it even mean? And the beauty is, if you type into Google inverted yield curve, it'll tell you what it is. It'll give you the definition. That's one of the benefits of the internet. Okay. So we can do that. We can do this experiment over and over again with different maturities and play around with it. We're going to do it till the cows come home. But you're going to get the same kind of results. But you'll notice when I did a 5-year versus 3-month, I got a lot more blue than I got red. And that leads to something as a personal investor. Okay, markets are lousy forecaster of future interest rates. They don't get it right, even on average, because even on average, they weren't zero. For the past 35 years, or I don't know where that's from, investors would be better off investing in long-term maturities most of the time. That's what the data shows. It doesn't say you investing in long-term maturities, you're better off all of the time. It just, you're better off most of the time in terms of investing in terms of long-term maturities, just because if this is what happened doesn't mean it will happen. That's the caveat any good personal investor advisor will tell you. Yes, we rely on the past, think about what's going to happen in the future, but you always got to throw that caveat in there that says, yeah, well, things could change. So if the markets are so efficient, how come markets are such poor predictors of future interest rates? This is a core issue in finance, because one of the issues in economic literature is called the efficient markets hypothesis. The markets are incorporating all the information and they're terribly efficient of using that information in terms of determining the price and the discounting of future cash flows. The problem is, in fact, when you put it to the test, you go, well, if they're so efficient, how come they're so lousy at it? And that tells you the nature of the future, which is, as much as we'd like to think that we know what's going to happen, we don't. And the financial markets are living proof over and over again. And so in terms of thinking about personal investing, you got to think about in terms of what are you trying to do? What can you live with? And probably the two conclusions and implications that come out of what I've gone through is there is one construct out there in equity markets that is robust, and that is called the equity premium puzzle. It has been there for a long time. We talked about it at the end of the prior class. The second thing to come out of this part of the class about interest rates, nobody knows what's going to happen to interest rates. You don't know what's going to happen. I don't know what's going to happen. And don't try to guess. Just come up with a strategy you're comfortable with and live with it, because the volatility is such that if you look back, you're always going to say, oh, I should have bought Google. I should have bought long-term bonds. I should have bought short-term. I should have bought short-term instruments. This kind of stuff happens all the time, and it's reflected in this. Okay, this is the answer to the negatively sloped, i.e. inverted yield curve. I use the 5-year minus the 3-month rate. Okay. And so this is what they're talking about. When the curve gets very negative, it's lined up. See these gray areas? Those are the recessions that followed the negatively sloped yield curve. And you'd think, well, heck, maybe these markets know something about recessions. And then you just look at where we've been, and you realize, well, this is, in fact, if you want to know about macroeconomic policies and macroeconomic, despite what you may hear on the media, it is unbelievable that they drained inflation out of this system and didn't generate a recession, and it looks like they're not going to. And this is an indication, as the Fed started to raise interest rates, that the market thought that there would, on something as basic as, well, they're going to generate a recession. Well, the unemployment rate's still below 4%. People, apparently, according to the polls, they don't get it yet that, in fact, the economy is doing extraordinarily well under the circumstances. But nevertheless, it is this data that where you hear that, negatively sloped yield curves by a lot, inverted yield curves predict recessions. Yes. 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 Puzzle. I use puzzle. The word puzzle, the equity premium puzzle. Okay, because we're still in the same lecture. Oh, go all the way back. Do, 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 do this. That's what it means. And what this means is what the equity premium puzzle is. You look at the average rate of return in holding equities for a long time. Oh, yes. What you get, I didn't hear you ask me to. Yeah, yeah. So the question is was what did I mean by the equity premium puzzle? And the answer is in this data graph. And what this data graph demonstrates is the variance of returns as your holding period increases, particularly you get out beyond 10, 15 years. The variance of your returns decreases significantly. This is the red line's about, in this particular diagram, is about 8%. Okay, and then you compare that to interest rate investments, and you say, this is a lot larger than interest rate investments. Why? That's the puzzle. Am I at Harvard? If I were at Harvard, that'll get me tenure at Harvard to come up with the answer to that. There's books on there. One of them is called Stocks in the Long Run, et cetera, et cetera. This is what they're talking about. That, if you invest in a diversified portfolio for a longer term, there's still variance of return. But if history repeats itself, the variance over longer term periods is going to be quite small. That's why you say to your grandchildren, you give them money and you say, put it in stocks. Get a diversified portfolio. Don't look at it. Just put it in there and walk away. And this is why. Because this is a robust finding, and it's a puzzle because we talked about Kahneman and risk models in terms of how persons react, in terms of how people feel about financial risk. Oh, there's a whole world now that's evolved. It's called behavioral finance, and it's all about how individuals feel and experience, and you put them to these tests and you find out they're a long way from rational because they have stronger feelings about losing money than they do about necessarily winning money. And there's about giving up gains. There's all kinds of things. You go to a gambling casino, you can see that kind of stuff happening all the time. And we have very sophisticated algebraic models describing this kind of behavior, but we cannot explain that. It's why they refer to it as a puzzle, because they haven't come up with an explanation. They just know it exists. They, me, us. Is that okay? Did that answer your question? Sort of. Well, we'll keep working at it. Okay, we did the tips. We did this. I think I'm almost done with this guy. Okay, so one last demonstration of risk and return. First, the line, there's no such thing as a free lunch. Boy, I'm telling you, that statement, it's a Milton Friedman statement, but is so true about our economic system. And it's an awful lot of politics involved, politicians that don't understand it. Take additional risk, you need to be compensated. Okay, some evidence from two broad market indices that I showed you a while ago. So I went out and collected the data from 1990, the NASDAQ index and the S&P 500 index through almost the end of 2023. The idea is, are you better off putting your money into the black line or the red line? And that's something I cannot answer. I can tell you, if you went to sleep for, let's see, this is 40, wait a minute, 30, for 33 years, and you didn't care about what happened in between, and you didn't make any adjustments, you just closed your eyes and waited, you would be wealthier having invested in the NASDAQ index rather than the S&P index. The problem is you're a human. And as you get into this market, it goes up, it goes down. In 1999, it went down 78%. What would you do? Would you stay in it? Would you just say, oh, I took Mike's course, so I know I'm just gonna. You're sitting there with having lost 3/4 of your financial wealth in that instrument, or in that particular market investments. Would you just live with it? That's at the heart of investing. Knowing yourself, knowing how you're going to react in terms of understanding these markets, in terms of what you can do, and just take a look at how the NASDAQ market responded and look at how it's responding now. It's going back up again. Okay. But what this says is you have to be compensated somehow. Why? Because this red line is riskier than the black line, and it is reflected in the market prices. That's what finance is all about. More is preferred to less, now is preferred to later, and less risky is preferred to more risky. Yes. Where they talk about winning winning the loser game. You're better off to don't try to beat the market to that just do as well as they. So so okay. Yes, but to fully do that, mm-hmm. Oh, the index has done better. And if you bought the index in 1990 and did nothing, you just held on to the investment, closed your eyes, just didn't pay it. Oh, it went way up. Oh, yeah, it'll come way down. I don't care. I'm just holding on to that index over a period of, I want to make sure I did this right, 10, 20, that's 30, period of 33 years. You would be wealthier today than you would be if you had bought the S&P index. That's true. But that's not what most humans do. And the evidence is that humans, they get scared. And what do? Oh, it's dropped 50. I got to get out of it. It's dropped 50%. And they sell, and then they wait and they think, oh, no, it's not coming back. Take a look at how long it took to get back to where it was. 15 years. That's a long time. That's a long time to believe in these simple graphs. And that's the point. It is the difference between what you see in the data, the price data, what you hear in the media regarding all these various claims about what you should or shouldn't do. And the reality is you're humans, and you're going to make adjustments along the way. And there's all kinds of reasons you make adjustments. You have to, you need money for a house, you need money for a grandchild, whatever it might be. But the real point is, even the surveys of value line diversified investors in one of the diversified portfolios show the average holding period is about 18 months. Even though the principle is to hold it for 10 years. And that's because you're a human. And just so you know, the higher rate of return, when we actually measure the volatility, yep, it's about 33% more, 1/3 higher in terms of its volatility based on that measure. Yeah. Okay. Okay, I'm going to have to repeat your questions for those taking the class at home. So the point is the experts, in terms of trying to beat the market, have had a very difficult time beating the market consistently. Is that what you're? Yes. Well, not only that, but where the literature is revealed is when they do various analyses of mutual funds and how mutual fund prices have worked. And that's why some just say you might as well just buy an index, forget the investors. There's all kinds of games out there. Well, if the investors beat, if mutual fund has returned more than the stock market for the last 5 years, and they have the same person that's managing it, chances are they're going to do it for the next 5 years. So people have done tests. Well, is their past performance any indication of their future performance? And in general, the answer is no. And because they have to be paid for what they're doing, the mutual funds, by and large, not all of them, but a lot of them will generate a lower return than just a diversified portfolio in the market. And that's why EITFs evolved and why they're as popular as they are. Yeah, they're exchange traded funds. So you can get into an exchange traded fund, and it will give you the EITF, and it will give you, say, an S&P exchange traded fund will give you the S&P return less less the fees they take out of it. I don't remember. You got a cell phone? You can look it up during the break. Okay, that's the end of the personal investment. Now let's see if I can get the next set of slides. While I'm getting the next set of slides, why don't we take a break and pick up at 2? How's that sound? In part because of his testimony in Congress after the scandal at Wells Fargo Bank. Okay, so the Fed considers all this. The federal debt grew by large amounts during the pandemic. What are the implications? You're going to find the conclusion. You will hear from me. Be glad they did. We are well better off, way better off. Yes. Did they overdo it? Sure. Of course they did. You know, of course, of course, people got money that didn't need it. We'll talk about that, but that's not really the point. Social Security is referred to as an intergenerational promise. Okay. There is constant talk about the bankruptcy of the Social Security Trust Fund. Is this word consistent with financial principles? Hopefully you'll learn from my course that it is not. It's related to Congress and how they say things. And what is the position of state and federal defined benefit pension funds? This is a big deal. There's no question, and you'll see why. So just going through the basic math of what does the government spend? Okay, first, the government purchases real goods and services. There's no question about it. That's called G, consumption, investment goods. A big hunk of the federal budget is associated with transfer payments. Transfer payments are just exactly what you think they are. They are taking money from individual entity A and giving it to individual entity B. That's why they just, quote unquote, just as editorial, but it is a transfer. That is the Social Security system. That is the Medicare system and the entitlement programs, et cetera, et cetera. Lots of money flows out of the federal government. They're called grants and aids to state and local governments. Just to give you an example, to feed the transit systems of the San Francisco Bay Area, I think the number that came in through the pandemic bailout was $4 billion, just to keep them alive during the pandemic. Which means, of course, they're funneling that money out to every metropolitan area in the country. So it was something like I think it was about 300 billion in total, but don't quote me. And then there's net interest payments. So right there's a connection in terms of what's going on. They pay interest on the federal debt. Gee whiz, isn't it true? As the federal debt goes up, there's higher interest payments. Well, what they pay on federal debt, sensitive to the yield curve. It's sensitive to what happens with interest rates and financial markets. And you're going to find by the end of this lecture, interest rates have been very high for the last year and a half, but prior to that, they were very low. And the question is, why is that? So if you look at federal government expenditures, okay, you can do it in terms of dollars, taking out the inflation component. This is done in constant dollars. Things look huge, but what economists always do, it's always you're dividing by GDP. You always want to know how big is the government relative to the overall economy, and what you find out is this is the end of World War II. This is the big increase during the pandemic, and there've been ebbs and flows, but by and large, the government expenditures have been hovering around 20% of the economy. Okay, so look at the all other. This is a percent of total federal expenditures, and what you find is the pandemic was extraordinarily unusual. Hopefully, won't be repeated. We won't need to do this again, but this saved, as inefficiently as it may have, those expenditures saved the economy from going into a depression. There is no question about it. Yes. Okay. Okay, so I'm going to repeat the question so those at home can hear what the question is. Where would you get the information on a source? And it really depends on the level of detail you want to see it, but there are some really good sources if you want to understand more details about this. The number one stop for me is the Congressional Budget Office. That was set up in the mid-70s. They do reports for Congress that are so good in terms, they're constantly explaining to Congress how different things work, how the macroeconomy works. They have to forecast the budget deficits, federal debt. They have to explain how it works. All of these different components. It's a really good source, and the stuff is it's written for Congress, so therefore it's readable. It's readable. If if you go to cbo.gov, okay, they're issuing reports every other day. They have lists of reports that they've issued over the years. I regularly use the information in terms of the graphics to make sure I'm up to date on the stuff. If you wanted more detail, where you say, oh, I want to know how much are they spending on bicycles, well, then you go to the Office of Management of Budget, and the entire, you can literally go to the websites now and get detailed information if you want to on all these different components depending on what you're interested in. It's there. Not a lot. I don't think a lot of people do it, but economists do. Economists regularly use this information. It's extraordinarily valuable in terms of understanding what's going on. It's the basis that the spreadsheets that you saw there, okay, that was data because they have the report, they have the data spreadsheets associated with the graphics in the report, and I download the spreadsheets and use the information for the course. It's all there. Yes. In 1947, I believe this was we're just picking up the fallback from World War II and the demilitarization. I mean, it took a while. It took a while to reduce it from 14 million guys in the military and come on, what's the name of the program that they put out there? Thank you very much. That's what funded my father to go to school and get a PhD in economics. Yeah. Yeah, yeah, yeah. No question about it. Okay. So the budgets, but believe it or not, from a very high level, it's two components. There's what do they spend and what do they receive? And what they receive are the components of the tax receipts. Personal income taxes, I hate to tell you this, but it's the biggest component. Contributions for social insurance, social security, it's a huge portion of the budget. Taxes on productions, imports, yes, that's a component. Corporate taxes, this is what was lowered in the 2018 tax bill during the Trump administration by a lot. And grants, and this shouldn't be here. And there are other revenues, fees, remittances. You go to a park, they pay for that. It's relatively minor stuff. The big ones are the first, really the first two plus corporate taxes. Okay. So you look at the revenues, you do the same thing. The revenues are growing over time. Okay, you got to do it in constant dollars, otherwise it just looks like it's growing out of sight. And then you do it as a percentage of GDP. And one of the things to notice is, gee whiz, this guy here as a percentage of GDP is less than the guys on the expenditures. And that's why we have cumulative deficits. They're not taking in revenues to pay for anything. So that is in fact what a deficit is. It is no different than it is the difference between outlays, how much it is spending, writing checks for versus how much is it receiving. And one can do the equation. It's how much are they spending, transfers, interest minus taxes and other revenues. That is what the deficit is in terms of how they do the calculation. Lots of detail underlying each of those things, but it doesn't really matter. For the purposes of this is just to set this up to say, this is what a deficit is, and a deficit is not debt. And that's important to know. Okay. The federal government has a budget constraint because outlays must be financed. Tax revenues, borrowing from the public. Those are the treasury securities. It is borrowing from the public, and the creation of high-powered money, sometimes referred to as printing money. This is when instead of the public buying the debt, the Federal Reserve buys the debt. That's in the subsequent lecture because the world changed in the fall of 2008 by trillions of dollars, as you'll see. So the government budget constraint is this. The deficit is the change in the treasury debt, which means it's change in the bonds that they've issued versus this is the bonds bought by the public and the bonds bought by the Federal Reserve. When people talk about them printing money, the term is the Federal Reserve buying bonds. It's hard to believe. You mean that's all that is? That's what they meant? Yes, that's what they meant. Okay, so it is the change in the amount of debt held by the non-Federal Reserve public and purchases of U.S. Treasury debt by the Federal Reserve. This is almost the end of the mechanics. Okay, the reason I do this in this course is because of this guy. Oh my. Do people not understand what federal debt is? How it's financed? Does it matter? How do we think about it? Okay. First of all, it is equal, the current federal debt is equal to all past deficits minus all past surpluses. Yes, there have been surpluses. Believe it or not, it was at the end of the most recent surplus in the federal government was the end of the Clinton administration. They had surpluses for a couple of years. Economists, I hate to tell you this, we don't care about debt. We care about the debt GDP ratio. Why? Well, you can't make heads or tails out of a nominal number. You got to know how big the economy is. And so it's the debt GDP ratio that really matters. And the correct definition of the debt is the debt held by the public. Okay, now you're going to find out the following. Beware of debt definitions uttered by media pundits, not just on Fox News, also on CBS, MSNBC. They regularly misstate this number, and I don't know why. They don't at the Federal Reserve. This is the example where there's some noise, there's a little bit of noise in this, but if you just sum up the data from what the reported deficits are and what the debt is, and what you find out is, look at this, the reason at the end of this is at the September 2022, the reason why you had $22 trillion of debt was because you had all the federal deficits, particularly in the last several years, associated with the meltdown and associated with the pandemic. That's the mechanics. This is non-political. This is addition, but this is political. It is the difference between the concept what is called gross federal debt versus the debt held by the public. And why should we know this? And why should we care? Debt of the US is almost equal to GDP is a reference to debt held by the public and debt held by government agencies. What is the debt held by government agencies? There's several of them, but there's only one that really matters. Social Security Administration. What are they holding? Are they holding securities? No, they're called faux securities. They're not real securities. They're not tradable. It is, in essence, they are counting numbers put into their account of the Social Security Administration. Okay? One could say, well, what does that represent? Well, it represents whatever you want it to represent, but it is not US Treasury debt. It is the left pocket borrowing from the right pocket of the same system. That is not an increase in debt. Okay, one can argue about how much we've promised, how much is going to be raised to the Social Security Administration. One can talk about all those things, but that is not the same as debt. And the difference is $5.3 trillion. The last time I did the calculation, and this has been around forever. Debt, they do all kinds of stuff. You divide the debt by the population, your kids are gonna have this debt, et cetera, et cetera. So they do all kinds of things to scare you about it. Right now, the last time I did this was about 6 months ago. It's $93,000 a person. You go, holy cow! The kids have $93,000 of federal debt hanging over them. No, it sounds large. It's used to scare people, and it's meaningless because of the following assumption. We don't get to live forever. The federal government does. The assumption is it's going to live in perpetuity. This concept is a key difference in terms of understanding what debt means. It doesn't have to be paid off. It has never been, with the exception of when we had surpluses and debt was actually reduced. That is an example where, quote unquote, the debt went down a little bit. But in an ever-growing economy, it doesn't never need to be reduced. The question is, from a macroeconomic policy perspective, what is the appropriate level of debt relative to the size of the economy? And for sure, the size of the debt relative to the size of the economy grew a lot during the pandemic. Now, was that a bad thing? Okay, that's what, when they're talking about the outrageous size of the federal debt, they were talking about the debt that increased during the Trump administration, because even the right wingers in Congress said, we cannot let the bottom fall out of this economy. Okay, and they initiated a bunch of various lucrative programs to bail out all, it's not just transit districts, individuals, unemployed individuals. There were all kinds of payments flowing through this system in order to keep people whole. And yes, can you come up with examples where you say, well, wait a minute, why did that guy get? Why did they get a payment? Okay, and here's why. In the real world, to determine you get something and you don't, that takes time. That takes administration. That takes controls and bureaucracies. And believe it or not, they did the right thing. They said, we're in a hurry. This economy is going south fast. We need money out there and we need it fast. And they threw it out there. Okay. And did they throw out more than they probably should have? Probably. Probably at the end of the day, when the history is judged, they'll say, maybe a little bit here and a little bit there. They shouldn't have done it so much. So what? The real point is, just remember what we were thinking during the lockdown in terms of where things were going and how scary it was. And, the economy kind of revived, and it kind of revived relatively quickly. And that's the reason, because they just plowed money into the bottom of the economy, keeping people whole. Okay. The other thing to realize is when you pay interest on federal debt, if it's going to a US citizen, it's just another form of a transfer payment. You're just saying, oh, okay, we're taking it from over here and putting it over there. So they're distributional economic impacts, but not real income impacts. But it is if foreign governments are buying US debt, which they are buying it. Yes. The question is, do economists believe uh, how much debt is too much debt for the US economy? And it depends on their political affiliation. Believe it or not. There's no magic number out there. And those that tend to be more conservative say we've got to reduce US debt. And those that are more liberal go, okay, how are we going to, okay, fair enough. I'm for reducing US debt right now. Okay. How are we going to do it? Well, are we going to do it by cutting expenditures, or are we going to do it by raising taxes? I mean, one of the biggest giveaways was the corporate tax cuts that occurred in 2018. There's a couple of $1 trillion there in terms of giveaway. Yes.
Same question with regard to the ratio.
Okay.
Is there a number that there's a great time we should cross for that?
No, same answer. The question was what about the debt GDP ratio? Is there a magic number out there? And the answer is there is no magic number out there. There are consequences over time. Everything all matters. The question is how. Okay, would I like to see a lower GDP ratio? You'll see in a minute over time in terms of how it's grown. Would I like a lower GDP ratio? Sure. Of course, I'd like a lower GDP. How do you get to lower GDP ratio? Well, it's mechanics. Technically, it's not, oh, we got to cut expenses or we got to raise taxes. Okay, well, there's a lot of people that depend on that. Maybe they should cut Social Security. What do you think about that? I should tell you, when I taught this course at Cal, 20-year-olds do not think they're ever going to collect Social Security. Why? They read it on a Facebook page. It's crazy. Yes, sir. Yes. Yes. There are examples of that, but not of the kind of economies of the United States. So they're called sovereign debt crises. And I got a slide on that. I'll show you in a minute. But can you get when you're a smaller open economy and there's a lot of foreign money coming into the economy in terms of the flows of what's going on in the economy, and suddenly those investors get scared? Yes, you can have what's called a sovereign debt crisis, and they have occurred plenty of times. But if you look at the list of the economies in terms of who had it and when they occurred, that list is largely smaller, more developed economies. Not in all cases, but mostly. Okay, so this is the graph to see how you really think about this. First, they publish you can get the gross federal debt and you can get the debt held by the public, and you can see that there's a difference in the number, and they've both been growing, and the difference is largely, it's not all Social Security, but it's mostly Social Security, and the ratio is almost on the public held debt. It may have crossed 100%, but this is the latest data I have. 100% has, cachet. It doesn't really make any difference whether it's 99% or 101%. It just doesn't. But it has political. Oh my God, the the size of the debt is now the size of the economy, and you go, so what does that mean? Well, think about somebody who's making $200,000 a year, and they borrowed money for a house. Okay, what are the rules that they use? Well, The rules they use in terms of deciding this is you may have other collateral. There's all kinds of reasons that the size of the loan might be very similar to their income, depending on what the collateral is and how much down payment they have. Well, it matters. It also matters in terms of the federal government. It is really the economics of debt is not about debt per se. It's about what is it for? Why do we have it? And what good is it to increase it? And what good is it to decrease it? And if you want to, there's political incentives there. It's easy to increase federal debt. You lower taxes and you spend money. That will increase federal debt. What's hard is, well, if we're going to pay for the place, then maybe we should have higher taxes or other revenues. There's all kinds of things. They've been fighting like cats and dogs over this stuff since the income tax first came into effect, of course. So it's all about fiscal policy in the short run. It's called Keynesian fiscal policy. There's a branch of economics. They don't like Keynesian economics at University of Chicago, but they do at UC Berkeley, and Stanford's a little murky. Stanford's a little murky on this. So what is this? Expansionary fiscal policies, deficit finance, can be used to stimulate the economy and generate more economic growth when the economy is weak. Okay, you're going to see, for example, during the Depression, all of FDR's programs were minor compared to what really brought us out of the Depression, which there's nothing like a war to bring you out of a depression. And World War II did it. Okay, so there's a lot of different ways to stimulate economic growth. You can do it through spending, you can do it through tax rates, and forever they're going to be debating this stuff, and forever you're going to hear debates about it. But you should just recognize historically it's political. The issue isn't really about economics. The issue is really about what are your values and how do you want to do and achieve certain goals. Yes, you can get people on the news programs who will say, oh, everybody knows that the federal government stimulus doesn't work. You just say, what evidence do you have for that statement? All you have to do is look at the data. What happened during the pandemic? That was stimulus. That was the federal government just writing checks in order to bail out the economy, to maintain economic growth when the unemployment rate hitting 20%. Oh my God, that scared people. No, you do not want the economy to go into a depression. That is not something that's a good thing. There is real economic pain associated with that. And the federal government budget is a way to keep us out of depressions, believe it or not. And the other example of that, of course, is 2009, the fiscal stimulus program by Obama that bailed out the economy and ended the meltdown from 2008. There's no question about it. But remember this, economists told Obama they needed $1 trillion of stimulus. And Nancy Pelosi and Harry Reid said they could never get that through Congress. And that's why it was $800 billion. It was $800 billion of stimulus, and it wasn't enough, believe it or not. So one of the things that makes all of this stuff difficult to talk about when you're talking about a news program and you're given 15 seconds to answer a question that really takes, a good half hour to answer is the following. Exactly how much stimulus you get from federal government doing stuff depends on where the economy is. If the economy is already at full employment, okay, there aren't a lot of resources to generate more economic growth. So if the government increases the deficit and you can't really increase production because everybody's already fully employed, well, the effect is going to be very small. Or it could be negative. It could just raise inflation. And that's part of the contribution to the higher inflation rates at the end of 2021. And what it also says is The deficits should be used to stimulate the economy, not to ride the economy into the future. And so the idea is you should use the deficit when you really need it, when the economy is weak, but when the economy is strong, there's nothing wrong with trying to balance the budget. And this is why balanced budget amendments never work, because balanced budget amendments don't recognize fundamental macroeconomics. You have to be able, I mean, if you had an amendment like that and the economy got weak, the deficit's going to rise because people are making less income and they're paying reduced taxes just by definition of how we do things, in which case the deficit would rise. And if you want to know an inverted macroeconomic policy, just try to cut the deficit in the middle of a recession. It'll make it worse. And that's just what the Europeans did in 2009. They made it worse because they bought into this idea, oh, we're like a household and therefore we need to balance the books. And, us being responsible will get people to buy more goods and services. No, it worked the opposite way, as predicted by Keynesian macroeconomic models for decades. So things matter. The structure of the tax cut matters. Position of household balance sheet matters. Fed interest rate policy and response system. All of these things matter. This is why one of my fields in graduate school is macroeconomics, because all this interesting stuff flows through these issues. Yes.
As far as deficit spending, so we didn't have a depression in 1929 or 1931.
Oh, good question. So the question is, if people understood macroeconomics as well as they do now and did it in 1929, would we have had a depression? The answer is we would not have had a depression, and it would have been both the Federal Reserve and additional federal expenditures that would have brought us out. Remember, in 1937, okay, FDR became worried about the size of the deficit and tried to balance the federal budget and put us into a second dip recession in 1937. Okay, because why? Of all the advisors, well, he hadn't read Keynes' book. It was published in 1936. I'm telling you, getting these ideas out there and getting them adopted is one of the reasons I lecture on this, is get people to understand how these things work and what the issues really are. Okay, what are the issues? Okay, we should have less debt now. How are we going to get there? That's the issue. Do you raise taxes on companies? Yeah, I'm an old lefty. Of course, that's what you do. Okay, should we cut transfer payments to poor people? That's what the right wing wants to do. Yes. Was Keynes responsible for getting the right solution? Keynesian economics and macroeconomics is the core sequence in macroeconomics at virtually every graduate school in the United States, with the exception of University of Chicago. And the academics, they're still those that would try to refute it, but by and large, Keynesian economics is dominating macroeconomic policies across the planet. Even the Chinese believe in Keynesian economic policies. Why? Because it makes sense. Academia is a completely different world in terms of how they do things and what they model and what they argue about. But the reality is, I've been in that world since 1976, and it's the same debate now. Despite the evidence, it's the same debate now that they've been having for decades, and the debate's over politics, because government's not the most efficient agency that there is out there. And wouldn't we just be better off with less government? You can go all the way to the extreme to libertarianism. You can come up with all kinds of models, but the reality is most responsible leaders in government realize it's a lot more complicated than that. And this particular set of rules works pretty well. Look what happened in 2008 and 2009. We had a financial panic in the United States that nobody had expected months before. And what got us out of that financial panic was the Federal Reserve and the federal government acting together to bail out the economy, following Keynesian economic principles. Okay? Nobel Prize winners in economics published an op-ed in the Wall Street Journal. It's famous in the fall of 2008 saying, oh, these policies won't work. Okay. It's been with it. It's like bad weather. It's with us. It's just part of the process. And the important thing is that the public understands what's really going on, because I'm telling you, the big thing that's coming is going to be the fight over this very number. Between now and the next presidential election, you better believe it. All of those people that voted for those policies that increase the federal debt are now dead set on trying to somehow reduce it. Yep, that's what it's about. Okay. So, what is the key of Keynesian economics and why does it matter? Why do we have this debt? It's called counter-cyclical structure of the federal budget. That's what a concept. It's like, hey, we're trying, the economy has its ups and downs, and what we want is for the government to intervene so it doesn't go up too much, it doesn't go down too much. And it's only it's really good at the extremes. There's no question about that. But in the intervening part, there's a lot of noise in there, and they're not the most efficient operators in the world, but it is the complexity. I mean, just think about it. This guy wrote one book describing the general equilibrium of national economies, and you can write it down in a few equations. It drives the algebraists in the economic departments crazy. It's so simple from a standpoint of how it works. Any case, so when the economy shrinks, tax revenues drop more in percentage terms than GDP. When the economy recovers, tax revenues increase faster. This is a built-in structure that, deficits increase in recessions. There's no question about it. And that's why it's silly to be thinking about any of this stuff without building in this reality. We're going to have recessions. Okay, if I could tell you when, if I knew when they were going to occur before they'd occur, that's a big deal. Yeah, the timing of recessions is a big deal, and that's why a lot of purveyors of the statistics, they say, well, we don't incorporate recessions, and that's crazy. Because if you're doing long-term planning, of course, you can do an estimate of what is the frequency of recessions. We don't know when they're going to occur, but when they do occur, they have impacts on the finances of local governments, finances of federal governments, finances of the state governments. And the wave is coming. If you're not sure about this, the wave of tax measures is coming to a ballot near you in an election near you, for sure. And the reason is, of course, is the complexities associated with remote work and how that has jumbled things up in terms of where the revenues, if you have any doubts, just go to downtown San Francisco and walk down the streets. You can find a parking place almost anytime you want down there. I'm telling you, this has implications in terms of how the city finances itself, how Oakland finances itself, and eventually the property taxes are going to get hit, and it's going to affect how the local governments, the cities and the counties and school districts get financed. And suddenly you're going to say, well, we got to bail out everybody. Really? You're going to get local taxpayers to do this? This is their current plan. So just beware. The federal government is different. The federal government is different because it has the ability to run large deficits and issue federal debt, and because in the federal government is this entity called the central bank. That'll be our next lecture, if I ever stop lecturing on this. So you look at the deficit ratios, the history of the deficit GDP ratio. Note the 30s versus World War II. Now, what happened there? As soon as the war broke out, do you think anybody said, oh, no, we can't give guns and ammunition to the guys out there on the front lines because we're worried about the. That's what all the bond sales were all about. That's what Clark Gable was doing on bond sales, trying to get people, individuals, to buy the federal debt. But ultimately, just look at the size of that puppy. It's huge. That was the end. That was the end of the Depression. There's no question about it. And you look, we can go through the ebbs and flows, and we will go through the ebbs and flows. This is the Obama bailout measure in 2009 that brought us out of the Great Recession, the worst recession we had. And this is the one that occurred during the pandemic. Okay. I mean, I look at this picture and I said, there's a story here. And this story is, this was federal debt that did a good thing. Okay. One can argue about this federal debt in here as to whether it was necessary and did a good thing. And the black piece there, those represent the surplus. There was a surplus after World War II, and there's the surplus at the end of the Clinton administration, and you can see it's mostly red ink. So you go through the history and learn the economic history. All of the FDR was very innovative in terms of all the programs that he generated. But they've done calculations. People have written papers on the bottom line. They weren't large enough. You had political support for doing only so much. And you didn't have the theory that, oh, well, it's, why don't we just do this? If they had done this, in answer to your question, the Depression would have been over. Okay, you also didn't have a central bank that recognized its responsibilities at the same time. Milton Friedman's the one who's written about that in the debates. Or, was it because of the Fed? Was it because of not enough fiscal stimulus? We're never going to resolve that. Ugh. Okay, so pardon? Why are there negative signs? Oh. So the deficit, I'm using negative to represent the red ink versus positive. Sorry about that. Yes, that's exactly. Thank you for asking. The negative numbers, for those at home, the negative numbers are associated with deficits. The positive numbers are associated with surpluses. And the thing to note is there have been occasional surpluses. Okay, then you go in 4, and it's a famous story. Johnson built up. We were a fully employed economy. The unemployment rate was below 4%. Johnson wanted to build up Vietnam, and he didn't want a tax increase because of the 1968 election. It was a small number, but that initiated and set off an inflation that really started to spill over into the early 70s, and that led to a whole decade of dealing with inflation until the end of the 1970s. So this is the 5th one. This is the Obama stimulus program, okay, which had really monumental effects. And as big as it was, one of the things that the political consequence, when you don't make it as big as it needs to be, the right wing will say, look at all this debt we created, but the unemployment rate is still high. The economy isn't growing. Yeah, that's right. Yeah, there are consequences from not doing it enough. The economy really was, the economy was really going down. And just so you know, it's Christina Romer who provided the evidence on the back of a napkin. It's a famous story. On the back of a napkin to Obama, she was the head of the Council of Economic Advisors. She's now over at Cal. Said, we need $1 trillion here. Oh, no, we can't do that. Well, there's consequences. There are lots of consequences from not doing enough. And this is potentially the opposite argument. They did a lot and maybe they overdid it. I mean, they're going to debate, what are the various consequences of this in terms of inflation, but I can tell you what they're going to end up. 1/3, 1/3, 1/3. They're going to say 1/3 over stimulus, 1/3 supply constraints, and 1/3 the Federal Reserve acted too late to raise interest rates. And we'll leave it there. We'll pick it up. We'll pick it up here next week because I got to go get my car before they steal it. Okay. Thanks. Oh yeah, got to remember I can't walk down.